Okay, maybe you went back, got yourself a cup of coffee or a drink or something like that, and we're going to continue with the basics of accounting. This is part two. Um, Let me just kind of get my computer set up here. Now, when you think about it, a basic accounting system has what we call a chart of accounts, and they're made up of types of accounts. Would be asset accounts, then your liability accounts, your equity accounts, and then revenue and expense accounts. So you got 6 different types of accounts. And I put in here, I said, the dreaded T account. It's actually a very simple concept. Each one of those accounts within the chart of accounts can be thought of as a T account. And this is one thing that tripped me up for a long time when I first got involved and started thinking about accounting. But it's fairly simple. In fact, that the T account that we set up within each one of these accounts, the debit side of things is the left side of the account. It is if you want to just say left side of the account, that would be fine. We're not going to. I mean, after this week, we're not going to really deal with this kind of stuff, but you need to kind of have, again, a understanding of it. It'll make you a better record keeper. So the debits are the left side of that account, and the credit is the right side of the account. It has nothing to do with pluses or minuses unless it's identified with a particular kind of account, like those 6 that we mentioned earlier. So when you think about that, debit is on the left, credit is on the right, and when we set up these accounts. We'll do some examples of this later on this week. But okay, so when the asset account, which is some of the main accounts that we'll have involved in an accounting system, the debit side, the left side, increases that account. Okay, so and the right side decreases that side, or decreases that account. So for an example, if we deposit $5,000 into our checking account, that would be one account within our chart of accounts called checking. If we did that, we deposited $5,000, it would debit the checking account. It would be an increase or a positive. It'd go on the left side of that account. Okay, if we wrote a check for $5,000, it would go on the right side of that account. Okay, and we need to keep this in it relates to the accounting equation that we talked about earlier, is that our debits, you have to have at least one debit and one credit if we're in an accrual system, a double entry system, accounting system. That's what we're going to be using. And the debits have to equal credits. Now we could have several debits and one credit. We could have one debit and several credits. As long as within the whole system, they add up to each other for the transaction, then we're in sync, and the accounting equation is kept whole, and it's equal. Okay, for a liability is, and we would think of liabilities being somewhat or opposing or directly opposite of an asset account, then it's completely different. The debit side, the left side, is a decrease in that liability. Okay? The right side is an increase in that liability. Think of it this way. You have a truck loan, and that's one of your accounts, truck loan. If you make a payment to principal on that truck loan of $1,000, you're going to decrease that liability, so you're going to debit that truck loan on the left side. Okay? So what if you had to borrow $1,000 to repair that truck? then that would be an increase to that liability, and you would credit that particular account. Okay, so that's how that liability T account works. The left side is a decrease to that liability, and the right side is an increase to that liability. We're increasing somebody else's share in the business by posting a transaction on the right side. Okay, so that's how that works. 3 subdivisions of particular T accounts. 3 of the net worth. We've got equity, which is income and expenses. Okay, and then we have also we have different income accounts and different expense accounts. Okay, and they're handled a little bit different. The actual equity accounts, if we decrease equity, that's going to be a credit. And if we increase equity, then that's going to be a credit. Did I say that right? By decreasing equity, we debit it. If we increase equity, we credit it. Okay, income accounts. All right. Now, an income T account. This could be like it could be an example of this would be cattle sales. Okay. So if we were to debit a cattle sales account, then we would be decreasing that account. Okay. So debiting means decreasing the income account. If we increase the amount of sales, which is what we generally do when we sell cattle, then that would be a credit to that income account. We made a sale. It's fall of the year. We sell our weaned calves, and then we credit our income account that is called cattle sales. Okay, this could be a crop income or could be a specific crop as well. So those income accounts, which we might have quite several, they wouldn't be as many as we have expense accounts, but we might have several categories or accounts that we would actually have under income. Okay, expense accounts are opposite of what your income accounts would be. Expense accounts, we might have in our chart of accounts one called supplies, and maybe we go down to the hardware store and we write a check for supplies, and we pick up some just things that we need around that we're going to use up. We're going to increase that expense account. We're going to debit that account because we wrote a check out of that. Okay. Now we're going to see how these things relate to each other later on, or a little bit farther down the road. But to decrease that account, we're not generally going to use that. We're generally going to be, if we write a check, if we use our credit card, if we use a direct deposit or a direct payment out of our account, or if we pay with cash, then it's going to increase that expense. So, for instance, for the example we gave, supplies, it's going to increase the supply account. Okay. You probably were wondering when this was coming. Whoa, anyone else feel like the room is spinning? Okay. Accounting gets that way, and I say, it's the exceptional person that can sit down and want to work on accounting like this and learn it. So when you get good at it, then you can spend quite a bit of time. But when you're learning it, you need to take frequent breaks. So the room's spinning a little bit. Take a little break here, and we'll get on to it a little bit. You can continue with this. We've got some examples of how these T accounts, or the accounts within your chart of accounts, interact with each other next.